Catherine Keating has had an amazing career in finance, more than 20 years at JP Morgan, running some of the biggest businesses at that bank, then CEO of Common Fund. And about a year ago, almost to this week, I think,
Probably.
you joined BNY Mellon as CEO of the wealth management
Yeah,
business.
last July, actually. Yeah.
Right. So I guess my first question for you is, how's it going?
Well, it's going well. They're letting me out of the office. Here I am. It's great. It's actually great to be there. You all know that, working in New York, if you work at Bank of New York Mellon, you're walking into a storied company every day. Alexander Hamilton was our founder, and it's just wonderful to be part of it.
What was the reason that you decided to join?
I guess really there are a couple of things. One is, and I'm sure you've been talking about this at the conference, this is an unusual time in the asset and wealth management industry. Normally, when markets are at, flirting near all-time highs, it's a pretty placid time in our industry. That's actually not the case these days. So it's sort of fun to be part of, the change and the challenges that the industry has and the clients have. And we have a great leadership team. It's always about who you work with, and we have a great team there.
That leads me to ask about your CEO, Charlie Sharp.
Yes.
I think you overlapped with him in your JP Morgan days.
Yes, we were at the company at the same time, although we actually never worked together. We were in different divisions. I was in asset management, and he was in the Chase division and the private equity division. Yeah.
But he did play a role in persuading you over.
Sure,
Yeah,
sure,
okay.
absolutely.
So
absolutely.
some of the old people joined again.
Yep.
So I guess tell me a little bit about, in your first year at this new challenge, what are some of the challenges you're confronting? I mean, you mentioned the changes of the industry, but what is it that you're specifically kind of digging into in your role?
So I guess it's a couple of things. If we sort of step back and look at the big picture, and I alluded to this earlier, there's an enormous amount of change going on in the industry. And start with the fact that if you had this conference 20 years ago, you might not even have wanted to talk to anybody in wealth management, right? We wouldn't have guessed that the retail market in this country would become larger than institutional, retail broadly defined, from the mass affluent up to the ultra high net worth.
And when you say larger, you mean in dollar terms, assets?
Larger in dollar terms, and also growing faster.
Right.
Right, and that we all know, why that is. It's the closing of defined benefit corporate plans and the retirement of baby boomers. 3.5 million people, sort of retiring every year and taking the money out of their 401ks and bringing it over to their wealth managers. So it's a really interesting time to be in that segment. We are keenly aware of the fact that we're really probably advising the first generation of folks in this country that are really responsible for their own retirement. And so one of the things that we try to do at BNY Mellon, you probably know our history is deeply institutional, is to take some of those institutional disciplines that made those pension plans and endowments and foundations and institutional investors so successful over time and bring them over into wealth management.
And you obviously at Common Fund, you were working with endowments, so you have had a great deal of experience with advising institutions. What are some of those lessons? What are the things that institutions know how to do that the retail client at a wealth management division can learn from?
Yeah, so I get there are a couple of things. One is, and anybody, I'm sure a lot of people here sit on boards of nonprofits, sit on investment committees, and if you just think about how you spend your time, right? You have an investment policy that leads to an asset allocation, that leads to regular rebalancing. There are just disciplines around investing, and we all know that asset allocation drives 90% of the variation of returns, and so focusing on those disciplines that institutions have is very, very important. The other thing is, one of the reasons that institutional investors have done so well over time is they tend to be countercyclical, right? Because they have an asset allocation, because they have a regular rebalancing methodology. As the market is going down, they're rebalancing and buying. And what we all saw in the retail market in the financial crisis is that we saw retail clients leave equities and pile into bonds for several years and miss therefore part of the rebound and part of the rally. So helping to bring those basic institutional disciplines around asset allocation, rebalancing, and compounding into wealth management is very, very important.
And how is that going? I mean, how are individual investors responding when you tell them to behave like institutions?
So I'll take us back to the fourth quarter. We all went through it, and it was it's sort of textbook in a way. We hadn't seen a lot of volatility in the market for lots of reasons that I'm sure you've been discussing here at the conference. And all of a sudden, we had a 14% down quarter. And the truth is, if we get out of the most recent 10 years, a 14% intra-year correction in the S&P is entirely usual. And in fact, it's kind of the average over the last 30 or 40 years. It's just that we hadn't had it. So if I think about the fourth quarter, we had a lot of clients, sort of very nervous about that. And, oh, is it time to sell? And, we were sort of talking them through why you have the asset allocation you have and why you ought to rebalance. And then sure enough, we got the first 4 months of the year, and they were back. Now, of course, May's been was an interesting month,
right.
But we're sort of we're seeing clients getting more used to this, and as we all should.
Right. Okay.
As we all should.
And are there any mistakes that institutions make that individuals can also learn from?
Mistakes that institutions make.
I mean, when you look at endowments and pension funds.
That's a good one. I guess, sort of broadly defined, I guess, one mistake that you could argue institutions might have made over time. If you look at the defined benefit pension world, whether you're talking about companies or public plans, the ones that have funding issues have tended to have them for one of two reasons. One is they just didn't fund regularly, or the other is in times when markets were good, they increased benefits. They felt very rich and they increased benefits. And so I don't know if you'd call that a mistake, but it's just something we've sort of observed over time. And so, back to advising the private client and being responsible for your own retirement, you need to invest for yourself, and you need to keep, start early and just keep doing it, which a lot of companies obviously support with, 401k plans and all of that.
Right, right. Okay, so what are your clients asking for now? What are they hot on, and what is it that they don't want at all?
So what are our clients asking for? One of the big differences between the institutional market and the wealth management market, the retail market, is that you move from a tax-exempt world in the institutional space to a taxable world. So our clients are keenly aware that the government is a partner in their wealth every single year, and actually even generationally, depending on their wealth levels. And so they're very, very focused on after-tax returns. As are we, and we have lots of tools and ways to optimize those today. They're also focused on, one of the hardest things for a family is to decide, well, what's the goal of this wealth? You think of every single institution, and they know what the goal is. I'm a pension plan, and my goal is to pay all my retirees. I'm a foundation, and my goal is to, spend 5% and earn more than inflation. For a family, you've seen one wealthy family, you've seen one family's goal. Everybody's a little bit different. And so focusing on that goal and then the levers that you can pull, only one of which is investing, by the way, to get there, we're spending an enormous amount of time on that.
Okay. So do clients ask you for sort of an outlook, sort of a macro view? And what do you tell?
So all the time, and we welcome that, right?
Okay.
Because if we can sort of agree on our outlook for the world, then we're likely to agree on, okay, so what are the steps then that we should take for you in this world? And so, when we started, it's interesting. It's been an interesting 5 months, I suppose, right?
Yeah.
This year, and an interesting day today. It's so nice to be here today, actually. When we started this year, we said to our clients, we'd say there's a 60% chance that we have slow, steady growth, steady as she goes. There's a 20% chance that maybe growth could surprise to the upside, and a 20% chance that it could actually really surprise us to the downside and lead to a recession. And despite, the sort of ride we've had so far this year and even today, we're still sort of there. We're still sort of there. Now, we're watching all the things that you are and that you've been talking about at the conference. We're obviously watching trade. We're obviously watching treasuries and the Fed, and we're weighing it all. The reason that Benjamin Graham's quote, in the short term, the market is a voting machine and in the long term is a weighing machine. The reason it's lasted for 75 years is because it's true.
Right.
It's because it's true. So we're trying to sift through the voting and the noise and really weigh what we think is likely to happen.
So, I mean, on a secular basis, growth going forward, do you see it matching what we've seen in past decades, or do you think there's been a change over time in terms of the sort of growth, projections?
So that's a great question, Christine, and thank you, because this is probably the single thing we spend the most time on with our clients. As I said, if we're trying to advise them over the long term, we kind of have to hopefully agree on what the outlook might be. What kind of world are we investing in, and what could the returns be? And one of the striking things about this decade, and we all know it, is that GDP growth has been lower. It's just been lower in this country. If you think about, the 50s and the 60s, we had whole decades with 4% GDP growth. If you think about the 70s, 80s, and 90s, 3% growth. And here we are in this decade, 2. This century, excuse me, 2. And we step back and we say, so why is that? And lots of reasons. I'm sure many of them have been discussed. But one of them that we think is really fundamental is that the U.S. economy is aging. If you look at the age in the average age of the U.S. in 1970, it was 28. Right now it's 38. And in the next handful of years or so, it'll probably be 40. And we know what happens when economies age. We've watched this happen in other places around the world. Growth slows, inflation is lower, yield curves flatten. Does this sound familiar to us? This sounds familiar. And so we talk about that outlook and the fact that lower economic growth probably means lower returns for stocks. Not dramatically lower. If you think of the S&P 500 having done 7%, on average since 1980, maybe it's 6. Maybe it's 6. But if you're planning, for your future, your retirement, a percent matters. A percent matters. And so how do you incorporate that into your assumptions, and how do you incorporate it into, your expectations for your own spending, right? If you're responsible for your retirement. So we spend a lot of time on that.
What are some of the suggestions you have for clients to accelerate their returns? If you see sort of a secular decline in the return environment, are there ways that you're advising clients to make up that?
Yeah, so it's a great question, because if you see deceleration in your portfolio, you want to have acceleration. And one of the areas that we talk to clients a lot about is private markets. Our clients tend to be fairly comfortable in private markets because chances are that's where they made their wealth, right? Founding a private company, maybe taking it public, maybe not. So they tend to be relatively comfortable as private investors. And the reason to invest in private markets obviously is to earn the liquidity premium that you can earn, hopefully, for being in private markets. So, we look to underwrite that return, right? Are you pretty confident you can make, at least 3% more than public markets by investing in private markets? But if so, we think that's actually a very good accelerator.
So private markets have had some shaky entries into the public markets recently. We've seen some flops from, Uber, for instance. Is that giving you any pause? Do you feel like maybe there's some overheating in the private markets? Because it does seem like one of the flavors of the last year has been people saying, oh, you got to go into private markets. So when do you get questions from clients about that, and how do you advise them?
Yeah, most definitely. And some of this is related to cycle, right? We're 10 years into this. We've already had the longest bull market, and we're just very close to having the longest expansion. And we know, as cycles age, there are sort of signs of aging. And if I think about private markets, I'd separate private equity from venture capital. Private equity markets over this last cycle have really matured, right? Much larger markets. I think something like $1.7 trillion actually was raised in private equity markets over the last 2 years. That's obviously a massive number. You look at purchase multiples in the U.S. buyout industry. At the conclusion of last year, I think we're something like 11 times. So you see signs of maturing, and entry points do matter, right? So when we look at that, we say, okay, We still believe you can earn a liquidity premium in private markets, but you'd really like to find entry points that are lower. And where do you tend to find that? You tend to find it in smaller companies, sort of lower middle market, the 250 million and below enterprise. Maybe you get a 6, 7, 8 multiple. That's the kind of space that we would focus in. Venture capital is a really interesting asset class because innovation is something that's not necessarily confined by cycle. Right? Disruption and innovation happens happens throughout the cycle. The change in the venture capital market really has been the amount of time that companies are staying private. Right? If you think of 1999, 2000, maybe it was 5 years. Now it's closer to 9 years. And so a lot of value creation is occurring in the private market. And so what really matters in venture capital is what stage are you getting in, and can you get in as an early stage investor? And that's just all about access and building the relationships with firms to have it.
So that brings me to a question about disruption in the wealth
Yes.
management industry. Where do you see the biggest disruptions to your industry? And I guess I have to ask about fees. How is
Sure.
that? How is
Yep.
the brutal sort of a decline in fees on any asset management products? Sort of how are you navigating that?
So I'll start with disruption.
Okay.
There's disruption everywhere in the wealth management industry. There's disruption just in terms of the competitive landscape, right? We have enormous scale players. We wouldn't have thought that you would have wealth managers with $2 trillion, right? We now have a handful of them. So you have enormous scale players that have really scaled up, really since the crisis. And then you have a lot of new firms, right? Being started, whether they're registered investment advisors, whether they're fintech firms. So the wonderful news is we have a large and growing market. It's more competitive than ever. So that's a disruption. Another disruption that we're going through, but I think slowly, is really demographic disruption. If you look at obviously wealth is accumulated more the longer you live, and so if you'll sort of look at wealth in this country, roughly 2/3 of it or so is held by the baby boomers and older, and yet they're less than 1/3 of the population, right? And so if industry surveys would say, the average age of a wealth management client is 63. And so we're looking ahead at a large, transition of wealth from one generation to the next, and the next generation is very, very different. It's different in all sorts of ways. One difference is if you think about the wealth management industry of today versus many decades ago, women are incredibly important. 90% of women will be responsible for their own wealth management and financial affairs for some or all of their lives. And so we're in the family business at Bank of New York Mellon. Our first client was actually Eliza Hamilton, Alexander's widow, when he died in the duel without a lot of money. There was the 1800s version of GoFundMe, and the wealthy New Yorkers raised money, and Eliza and the family was our first client. So we understand that, but that's a major disruption as well.
Right. And fees, finally?
So fees, everybody here in the room, I hope you feel that today is a really great time to be a client and an investor. Fees are lower than they've been, and congratulations. They're probably going to continue that way. And that's actually, very, very good news. What we find is, the thing that actually adds the most value to our clients, it's not any one product. It's not any one product. We actually are trying to step back and say to them, in the old world, alpha was, pretty narrowly defined. Did I beat the benchmark? Am I doing better working with you because I beat the benchmark? In today's world, where you're responsible for your own retirement, your future, your family's, goals, it's really, is my family doing better working with you than if I did it on my own? It's really a much broader definition of alpha, and investing is certainly a part of it, but so is spending, right? Spend rights are enormously important. So is borrowing. Our clients don't have to borrow, but oftentimes it makes sense for them for periods of time or even the long term. It's managing to the after-tax returns, and it's protecting everything that you've built over the years. That's everything from insurance to trusts, which can protect from claims and all of that. And so there's a much broader definition of alpha, I think, in the wealth management industry today, and that's what we try to focus on. And the value of that is actually really significant. We try to calculate the value of these different disciplines for our clients, and it's anywhere from 2.5% a year to 5% a year if you can get the
How do you calculate that?
multivariate. Well, we take them pillar by pillar. Investing. What's the value of having the right asset allocation, rebalancing, compounding, diversifying? Those are things that you can quantify. Really significant. Spending. Unbelievably important. It's the one variable you really control, and every half a point difference in spending has a huge impact over the long term. Same as taxes, right? Doing the regular tax planning, estate planning, and all of that is enormously impactful. So we try to focus on all of those.
You have to be a holistic sort of money advisor to your clients.
We do.
Okay. All right. Well, thank you so much, Catherine Keating. I'm really happy to have you.
Thank you.
Thank
Great
you.
to be here.